The role of human psychology, the source of short-term thinking. 1. The desire for instant gratification in human nature. Human psychology is naturally inclined toward immediate results and rewards. In financial behavior, this appears as the pursuit of instant gratification. Short-term gains often feel more attractive than long-term processes that require patience. Psychologists have extensively studied this tendency, and it has a strong influence on investment behavior. 2. Loss aversion and short-term perception. Investors fear losing money in the market, which pushes them to react quickly to price movements. This fear increases rapid decision-making instead of long-term waiting. The human brain often prefers small short-term gains over larger long-term gains, and this affects financial decisions as well. Behavioral finance and cognitive biases. 1. FOMO and the impact of social media. Social media platforms cause investors to react quickly to trending assets, fear of missing out, FOMO. Research shows a positive relationship between social media usage and short-term investing behavior. When we see a trending asset, the urge to join increases. The actions of other investors shape our own behavior. 2. Herd psychology. Investors sometimes make decisions based not on fundamental analysis, but on what others are doing. This strengthens short-term, trend-chasing behavior. The expectation of quick gains combined with social influence pushes individual investors toward more active and sudden decisions. The convenience and speed brought by technology. 1. Instant access and online trading. Digital investment platforms allow immediate buying and selling. This leads investors to react more frequently to price changes. 2. Accessibility immediate reaction. Information that was once available only to institutional investors is now instantly accessible to individuals. This encourages quick profit from price movements. Strategies. Technology has made short-term trading easier and more appealing. Market structure, liquidity and price movements. 1. High liquidity and rapid price response. High liquidity in financial markets allows assets to be bought and sold easily. This encourages short-term movements because investors can quickly change their positions. 2. Volatility and wave chasing. Volatility provides large short-term price swings, making short-term on-off strategies more popular. These market characteristics do not force short-term strategies, but they certainly create space for them. Institutional and regulatory pressures. 1. Quarterly performance pressure. Companies and fund managers are often evaluated based on quarterly performance reports. This pushes both corporations and investors to focus on short-term results. 2. Short-term distortion from institutional investors. Some professional funds must focus on short-term results, leading them to frequently adjust positions, influencing broader market expectations. Institutional structures and reporting cycles can push investor communities toward short-term thinking. Information and perception problems. Insufficient research. According to one study, most investors spend only a short amount of time, approximately 6 minutes, researching before buying a stock. This encourages superficial decisions instead of deep analysis. This reinforces the focus on short-term price movements. Summary: the main reasons behind the rush to the short term. Psychology, instant gratification and loss aversion. Behavioral finance, FOMO and herd behavior. Technology, online platforms and speed. Market dynamics, liquidity and volatility. Institutional pressure, quarterly performance focus. Lack of research, limited information and shallow analysis. Conclusion: the rush toward the short term is not caused by a single factor. It is the combined effect of psychological tendencies, technology, social influence, market structure, and institutional systems. As these factors work together, investors become more inclined to choose faster results, instant opportunities, and decisions that provide a short-term sense of achievement, rather than sticking to long-term strategies.